On Monday, the 19th of October, 1987, the Dow Jones Industrial Average plummeted over 22%. It remains the single largest one-day percentage drop in stock market history. While brokers tore at their collars and institutions hemorrhaged billions, a 33-year-old hedge fund manager named Tudor Jones calmly added $100 million to his firm's books. He did not do it by being brave. He did it by playing defense. That lesson is back in the headlines this week, and on the 10th of August, 2026, it is a wake-up call every investor needs to hear. Massive sell-offs are never really about geography or decade. They are about human nature. And Jones understood that protecting what you have comes before dreaming about what you could gain. Just days ago, Barchart and multiple financial outlets republished the story of Jones's legendary trade. It was not nostalgia. It was a deliberate reminder. In the run-up to August 2026, questions about stretched valuations and geopolitical friction have put capital preservation back at the center of the conversation. Jones spotted the 1987 crash weeks early by studying historical patterns. He noticed that the market was mirroring the setup of 1929, with an overextended rally and complacent sentiment. But the insight was only half the battle. The real genius was how he structured the trade, a short position sized so that if he was wrong, he would lose a manageable amount. If he was right, the payout was enormous. That asymmetric risk profile is the textbook definition of playing great defense, and it explains why his quote is still quoted in trading rooms today. The most important rule of trading is to play great defense, not great offense. Defense does not mean avoiding risk altogether. It means managing it so meticulously that a single mistake cannot wipe you out. For Jones, that meant defining his maximum acceptable loss before ever entering a position. It meant using stop losses religiously and never allowing a winning trade to turn into a catastrophic loser. Many traders focus on how much they could make. Jones obsessed about how much he could lose, and then let the upside take care of itself. That is why, when the market opened on Black Monday and chaos swallowed the trading floor, Jones was not scrambling. He was already positioned. He did not need the market to cooperate with his hopes, he had already secured his downside. This defensive posture transforms panicked investors into disciplined allocators of capital. The numbers from that day prove it. While the market lost a fifth of its value, his Tudor Investment Corporation delivered a triple-digit return, all because defense came first. Markets may have changed in speed and structure, but the emotional cycle that drives bubbles and busts remains identical. The reason publications are surfacing Jones's story right now is not coincidence. It is a signal that seasoned investors are beginning to emphasize capital preservation over aggressive return chasing. Whether you are managing a FTSE 100 ISA or trading volatile single stocks, the principle holds. Before you ask what you can make on a trade, ask what you are willing to lose. Set that line in advance. Keep your position sizes small enough that a sudden adverse move does not force a distressed sale. That is the practical, immediate takeaway from the 1987 flashback that is trending again this week. Jones himself has repeated the message in recent years, including a Yahoo Finance feature that reminded readers one should not focus on making money but on protecting what you have. That is not pessimism. It is the strategy that lets you stay solvent long enough to profit from the next opportunity. The $100 million day was never just about the money. It was proof that disciplined defense is the ultimate competitive advantage. Black Monday destroyed careers and erased generational wealth in a matter of hours. Tudor Jones emerged stronger because he respected the market's power to inflict damage and built his entire strategy around surviving it. Today, on the 10th of August, 2026, that single sentence from Jones still echoes louder than any market timing formula or complex derivative. Play great defense, not great offense. Master that, and you will still be in the game long after the overconfident bulls have been carried out of the ring.